Well, welcome. We've got a good group joining here today. We'll give us about 2 minutes for everybody to log on, and we will get started.
Is there like a waiting room that people have to clear, or how does it?
I think there's so much of a herd, it's kind of the plumbing of the Zoom pipes that I do not want to know any more than what I said technically about that, by the way.
Yeah.
But yeah, so it's sort of a burst comes in. It looks like we're up to maybe a third that have registered, have jammed their way in. You know what this is like, Russ? This is like the geeks at Black Friday, all trying to get the best TV and just like trampling each other to get in. They're just so excited. That is exactly what's happening virtually, yet in real time. So give everybody another minute or two. Let's see. I want to be careful on time. Another 1 minute. We'll get started. So as we always say, the biggest trepidation of any of these webinars is that we sure hope you see us and we sure hope you see the screen. So for those of you who have attended in the past, you sort of know the routine. So if you could maybe raise your hand just to let us know that you can hear us and see the screen. Excellent. Thank you. Thank you. Nothing worse than asking that question and not seeing any hands go up. So I've had that happen before, and all my good jokes went very flat, or perhaps they were heard, but they went flat anyway. Don't know, but very good. Well, let's go ahead and get started. So we've got a lot to cover today. I'll go through a couple housekeeping notes. So I am Brian Klontz, president of Charitable Solutions. I've got my two partners who will be doing the heavy lifting today. Ryan Raffin, who's lead partner for all sort of non-cash compliance. Many of you, I think, on the call perhaps worked with him. And then Russ Willis works with the firm and sort of has worked with the firm over time on all kinds of different projects. Last probably, 10, 12 years minimum, sort of on various cases. So you see and you know why you are here. So we're going to talk about non-cash qualified appraisals gone wrong, deconstructing the appraiser and appraisal requirements, as well as Forms 83 and 8282. So as we go through, again, some housekeeping. One, we do not tend to send the slides out. We've had some issues in the past with, we'll call them nefarious uses, repurposing of those slides. But this is free, as you know. And so we do actually post the best recording. So we had one on Tuesday that I would say, I don't know, B+. So if we've got to use Tuesdays, we'll use Tuesdays. But I'm sure that today's will be an A+, so we'll be able to record this webinar, post them onto the Charitable Solutions website under Resources and Webinars. We have about a dozen or so of each of our monthly webinars posted there. And long story short, you can watch it 57 times if you want to. Hope you don't, but that's your choice. And you can certainly forward that or watch it at some later point in time as well. So again, all free, no codes or anything else. So that's sort of the quick housekeeping. I would ask that if you include any of your questions in the Q&A, we'll probably monitor chat too, but ideally Q&A, and we'll try to do our best to answer those sort of in real time unless they're crazy complicated. In a good way, we were sort of overrun with very engaged questions, I would say, on Tuesday, and so we've made the collective decision to hold any questions until the end. Most importantly, as part of the follow-up, you'll get a link next week for this webinar once it's posted, as well as the Q&A from Tuesday and the one from today. We'll scrape all of those, put in a little word table, and then answer the questions. Long story short, ask your question. You'll not only get a response to yours, just may not be in real time, but you'll also get the benefit of seeing what other questions obviously are being asked, both from today's session and from Tuesday's. So with that, let's launch right in. So you guys always, I know, are so eager to join to hear the 6 to 7 minute advertisement on Charitable Solutions. So we do this for free, so this is our big marketing plug. Hope it's not too painful, but I would say I founded the firm in 2003. We got about 400 clients, and I bet if I asked half of them what we do, they'll say, I know exactly what you do. You do this one thing. And I would say, yes, we do that one thing, but we also do 5 other things. And they say, we had no idea. And I said, I'm the worst marketer ever. So to try to remedy that a bit, Charitable Solutions has one mission, and that mission is to help make charitable gifts happen that otherwise wouldn't, period. So we have a team of 16 and focus exclusively on supporting charities and charitable transactions to help lubricate that process, both for what I'd call the due diligence digestion portion, as well as some of the compliance portion of that, which we're talking about today, as well as hopefully educating people about the opportunities for that. So what do I mean by that? So sort of going maybe all the way to the right top side, the least, I guess, connected to what we're going to talk about today is the Emergency Assistance Fund Administration. So I founded another charity 10 years ago called the Emergency Assistance Foundation. And what that does is it's a public charity, and we're able to set up component funds for large companies that want to create a charitable bucket for them to be able to support their own employees domestically and internationally, so globally, for disaster relief and for personal hardships. So we do a lot of that work. We got about 180 staff over there right now. You can see about 300 different companies. We did over 250,000 grants last year, 250,000 grants, a lot of grants. So for COVID, all kinds of relief. So spend a lot of time, and to me it's interesting, perhaps not to you, but it's this risk. Again, it's all about managing risk between the nexus between the employer and the employee, such that it could be a charitable donation, but it can be an independent arm's length review such that the donation is deductible by the company, by the employees, anybody else, and that the grants received by the grantees are tax-free. And so again, all back to this sort of helping make gifts happen that otherwise wouldn't through entity management and risk management. So that's the first one. Bottom right, what we're doing right now, continuing education. Typically do about 70 to 90 of these talks per year. And you can see there for both CE, for advisors, for boards. I've got a 2-hour board retreat today that I'm doing this afternoon. And then certainly to donors and nonprofits around this education. So Ryan does a good bit of that. Gary Snerson on our team does a good bit. Russ does a good bit. So we really have a stable of people around our weird little esoteric lane of topics that may be of interest, and then we're able to obviously deliver those topics. So that's more the educational side. Sort of top middle, gift annuity risk management. So the real 2 things that we focus on are non-cash gift transactions as well as gift annuity transactions. And in my career of 28 years and having this firm now for 18 years, the reason why we focus so much of our intellectual capital, which is probably being depleted by the day, around those 2 particular areas is those are the only 2 types of gifts that a charity, if things go sideways, can actually lose more than the original gift. So it seems logical that there ought to be some more risk management around that. So gift annuity risk management, we have 2 actuaries on staff. We've done maybe 300 or so stress testing of typically large CGA pools. You see the stuff that we do there, primarily focused on very large concentration of risk. We do both design for the insurance companies and placement of reinsurance contracts where that's appropriate. Working on 2 gift annuities right now. One's about $48 million, can't make that up. One's about $25 million, can't make that up. That's in the last 60 days. So some biggie gift annuities are coming in, which sounds great until the dog catches the car and you say, uh-oh, now what? What do we do with this? So a lot of speaking, a lot of writing, research, projects for the Society of Actuaries run mortality studies. We tend to weirdly live in that geeky space. So that's gift annuity risk management. The left side is really the core of what we do. And so non-cash asset risk management, talking about that now, obviously from a substantiation standpoint, and that is looking at any kind of illiquid gift that a charity otherwise would decline for whatever reason. We always say from a good donor with a good asset wanting to do good things, don't say no. We can either help as consultants, help that process of the charity receiving it directly, maybe 5% of our work, or about 95% of our work is with a charity said, we can't do an S-Corp in 4 days. We don't want to deal with 180 acres in Uganda, which we have, by the way. We don't want to deal with granite interest or the literally charging bull number 1, the Wall Street bull, as a sculpture donation. We've done all of those things. Tons of real estate, and privately held business interest gifts globally. If the charity otherwise would say no, we say don't say no. You can refer that to our foundation, set up 18 years ago, Decamai Foundation, and Decamai Asset Trust, trust form donor advised fund, specific for UBIT assets, primarily S Corp, Active Business LLC. Working on 2 right now, debt financed real estate LLC flow through. So that's a way to be able to potentially capture the gift without taking it in directly by referring it over. We're an independent public charity. We do all the sausage making. We do all the junk. We take in the asset. We do everything. And then once sold, the 2 unique things we do, we only take in illiquid gifts and complex gifts. And we never, I should say, manage liquid funds. So we take in illiquid or complex gifts, and then we never manage it once it's liquid. So 30 days after liquidity, it's then being granted out to the charity or charities that the donor was trying to give it to in the first place. So it's still a donor-advised fund, completely compliant processor, but really is a pass-through entity for those gifts. You can see there about $403 million in value donated last year alone. That's exactly 100 gifts. Weirdly round number, I'm well aware. So obviously, I'm a math guy, but doesn't take too much math here. That's about $4 million per donation on average. 100% of those transactions were declined. That's the only reason that we were referred the case. So we've done about $1.6 billion now through the foundation, all of which were originally declined. Charity said, uh-oh, why don't we refer this over? We do this stuff. We then make the grant over to them. Average fee about 1.6%, bumps between about 1.4 and 1.6 on that average size gift. And the National Gift Annuity Foundation, all you need to know is same thing, except I set up another foundation just to be an outsourced provider for gift annuities. If you don't have a program and you have a donor that wants to do it, we can help be the outsourced partner to do that. If you've got a great program, but you're not in California or New York or Washington, we're in every state except for Hawaii. So we're able to take that in. Real estate gift, S Corp gift, we deal with those. You can give us a call. Long story short, we manage the risk by taking on, again, the sausage-making component of a gift annuity. And then most importantly, you see there at the bottom, 100% of the residuum is then passed back as a grant to the charity or charities, again, the donor was trying to give it to in the first place. So that's really the structure. The one sort of middle bottom, big announcement really on Tuesday, repackaging some of the appraisal services that we were already doing. Charitable Appraisals LLC. So now we're able to offer qualified business appraisals for all entities, cryptocurrency, which is what I've done for a number of years, restricted stock, life insurance, which I've done about 15 years, and now we brought on 3 other consultants in this space, qualified appraisers where you see the rest, fractional real estate interest, brought on one yesterday, so Alan Bruce, I'm going to do Alan. So for all things collectibles, artwork, all of that stuff is now sort of joining Charitable Solutions to help with that component. Long story short, our goal is to only do, we have one lane, we're a one-trick pony. We get excited when people ask us to do our one trick. That's our one trick, charitable stuff. And so we only do charitable appraisals, only making sure that they're qualified, and then have a cadre of consultants that we can use to help perform, hopefully, quality qualified appraisals, USPAP compliant, 8283s, and so forth, for any kind of one-stop shop need. So that's it. I hope it's helpful. Bottom line to summarize, to help make gifts happen that otherwise wouldn't, period, and doing that in such a way, good donor, good asset, wanting to do good things, don't say no. In some way, somehow, we can help that process through risk management and our team of consultants. So with that, I want to pass this over to Russ Willis, who's going to take us sort of the first chunk of the way. Ryan will be sort of jumping in as well. Again, any Q&A, anything else, just put that in. We'll do our best to sort of answer in real time, or we'll follow up later. And I forgot, I'm doing the agenda. Everybody panicked on the phone. I'm doing the agenda. We're talking about non-cash valuation background. That's Russ's side. Qualified appraiser and appraisal defined, sort of what does that mean? Common donor goals as it relates to these kinds of valuations. Deconstructing 8283 and 8282, simple two-page documents, except they're not simple, right? So we're going to go through some of the reasons, like, that's weird. Why does it say that? You're going to ask us questions, and we're probably going to say, we don't know either. So there's going to be some gray in some of this, too. That's part of the process. And then Russ will take us through some lessons learned. He had that great phrase, sort of the foot faults that occur in this space that aren't so good. And so foot faults when you're dealing with a $4 million average transaction, as we are, not a good conversation to have. So some of these things that we've learned from former cases, and you can see, just read the disclaimer. Don't sue us. These are free, for the love of God. So not giving tax, financial, legal advice, blah, 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 blah. So I hope, and what I mentioned on Tuesday's call, I love the fact that we have a little mini herd of geeks, because this is like a geek out session here. And the fact that almost 400 people have signed up for this lets me know that geekism continues to survive. So you're here among friends. You can flap your wings, all kind of stuff. So any questions that come up, definitely let me know. So I'll hand it over to Russ now to take us through the session.
Thank you, Brian. Good morning, everyone. Good afternoon, I guess, for a lot of you. I'm talking to you from Tucson, where it's still sort of mid-morning. You have the word, gone wrong in the title, and we will get to some instances toward the end of the hour in which, things didn't go well. But we want to talk for the first part of the hour about, what are the rules so that we can kind of know how to do it right. And because it's Russ Willis talking at you, you know that the first slide is going to be about tax policy, because that's where I always begin the discussion. There are in the tax code very strong incentives for people to make non-cash gifts to public charities. We're not talking about a non-operating foundation, public charity, DAF, whatever. If you're holding a long-term capital asset and your gain would have been long-term, you contribute that asset, non-cash, to a public charity, you get a deduction at fair market value that offsets your ordinary income. And at the same time, you don't recognize the long-term gain. We had a talk a couple of months ago about pre-arrangement. We're going to kind of stay away from that today. And if it's a life income gift, you do, eventually recognize the gain, but it's going to be over time, sort of like an installment sale. There is this limitation that because it's a non-cash gift and it would have been long-term gain, that you're subject to deducting only 30% per year of your adjusted gross income. But you do have a 5-year carry forward. So if you're able to time things correctly, very strong incentive for non-cash gifts. And the problem, of course, is that whenever you create strong incentives in the tax code for anything, treat something as debt rather than a dividend and so forth, exempt org versus non-exempt org, deductible versus not deductible, amortizable, whatever, you're going to find operators. And of course, the problem with this particular situation is, how do you value the non-cash gift? And the footnote here that there are even stronger incentives for conservation of facades. As you know, if you're reading the press, that is also a battlefield for IRS right now. They're conducting a rather strong pushback against overvaluation on conservation of facades. So let's page forward, take a look at this this problem here. So, I'm going to guess through the mists of time that who actually instigated this legislative push back in 1984 to create the reporting regime that's going to be the focus of our talk this hour was probably Treasury. They were probably saying, look, we don't have the tools. Go to Congress. We don't have the tools. There's a big problem out there. Give us some tools. Even today, the audit rate on individual returns is very low, and the audit rate on partnership returns is completely negligible. So, some fraction of 1%. But in 1984, the Congress stepped forward and said, okay, look, we're going to try to address this problem of people playing the audit lottery by claiming a deduction for something that is difficult to value. And then, letting IRS decide, do I want to target this return? How do I even know when this is a problem? Well, there is a line, of course, on Schedule A that says cash, non-cash. You make an entry on non-cash, you're going to be attaching an 8283 in most cases. This is what Section 170F11, enacted back in 1984, is all about. If you're going to be claiming a deduction for a non-cash gift, you got to raise your hand and say, IRS, come hit me, okay? And so that's what this is about. And the 8283 is where you put up this flag and say, okay, IRS, I'm claiming something. This is your opportunity to come and audit. In that same legislation, there is a lot of text that was not actually put into the code. It's just in the nature of instructions to IRS. saying, look, we want you to regulate in some detail in this space. And we want you to require the donor, we want you to issue detailed regulations requiring the donor to get a qualified appraisal. And you're going to tell people what makes an appraisal qualified or not qualified. We want you to require them to attach some kind of information to the return. This is where the 82, 83 even comes from. That says, okay, we got the appraisal, and here's a little bit about what that appraisal says. And specifically, we want you to require on that form, whenever you develop it, that the donor discloses their cost basis in the contributed asset and how long ago they acquired it. That's actually in the section 155 of the legislation, telling IRS these things are important. You figure out what else you need. Okay, so let's look at the next slide, because then this here's some more instructions that they gave to IRS. When you're telling people what is a qualified appraisal, we want you to include at least these 6 items. Describe the property, tell us the fair market value, put in language in the appraisal document and in the summary appraisal report saying that we prepared this. The appraiser says, I prepared this appraisal for income tax purposes. Why is that requirement there? And you will see that sometimes it's omitted, and that is one of the footfalls that Brian was mentioning. It can be a problem. Why is it there? The Finance Committee report accompanying this legislation said, we want the appraiser to know that they are stepping into a situation where if they participate in overvaluing this asset, their license is on the line, okay? So we want to include this language in the appraisal because it's just a heads up to the appraiser herself. You know, you be careful here, do things right. You want to mention what the qualifications of the appraiser are. She needs to sign it. She needs to put her tax ID number. I think Ryan will mention later, tax ID number, not some other number, and anything else that you, IRS, think is going to be necessary. And then we also want you to put some definitions into your regulations and say, well, what is a qualified appraiser? And at minimum, we want you to talk about how the appraiser is not sort of captive in the pocket of the donor or the donee organization, or even the entity that sold the property to the donor to begin with. And we want the appraiser not to be basing their fee on the stated value or on the size of the deduction. So these are the instructions from the legislation telling IRS what has to be in the regulation at a minimum. So here's the regulation. This came out, within just a couple of years after the legislation. And here's some of the stuff that IRS said. Well, on top of what the legislation told us, here's some of the other things we need. We need to hear whether you've made some agreement with the donee organization as to how long they're supposed to hold it, when they can sell it, and so forth, how they're going to use the property. And we need to hear from the appraiser, what's your methodology? Did you capitalize income? Did you talk about replacement cost? If you're looking at comparables, tell us how you selected the comparables. And then in the regulation, however, they do kind of leave an out for if you're not able to cross every T or dot every I. You need to be able to explain why not. How come you're not able to give us the basic information as to when you acquired this property and how much you paid for it? And you will see, obviously, that those are the sensitive points that sometimes a donor wants to kind of hide the ball, because I acquired it last year at a fraction of the value that I'm now claiming. So if you're going to be omitting those things, you need to have a good explanation as to why they're being omitted. So let's page forward. Then over time, the Congress felt that maybe we weren't doing enough. And I'm not sure who the instigator was here, whether Treasury came back, because I think Treasury probably had the authority to do this. So I think Congress basically was stepping in and saying, we still have problems, you need to do more. Treasury, you need to do more regulating in this space. And they enacted an amendment to Section 170F11 in 2006, part of the Pension Protection Act, saying, we need to focus a little closer on who exactly is a qualified appraiser. And we need to get some assurance, IRS, again, Treasury, get out there and regulate in this space, give us some regulations, talking about what kind of education these people need to have, what kind of experience they need to have, maybe get some certification from a professional organization. And we specifically want to know that their education and experience qualifies them to give an opinion on this particular type of property. They don't really say what a type is, and we'll talk a little later about, where the phrase type of property doesn't necessarily tell you everything you need to know. IRS tried to issue some regulations fairly immediately, but they ran into a lot of pushback because of the difficulty of trying to say, well, what exactly are going to be our appraisal standards? Who's going to set those standards? How do we find out who's getting, where you get your education? What kind of education? What does certification look like? They got a lot of pushback on the initial draft of these things, and it took them 10 years to come up with the final regulations. And there are plenty of people, probably on this call, who are still not happy with the final product. So let's take a look at what they finally came up with. This is how it looked when they finalized these regulations in 2018. What are the generally accepted appraisal standards? Well, they basically passed the ball. They said, well, there's something called the USPAP appraisal standards, and those are developed by a nonprofit organization called the Appraisal Foundation. And basically, Treasury and IRS said, as long as you're conforming to something that looks like those standards, we're good. But on the education front, they actually want you to have professional or college level coursework in a brick and mortar, university, graduate school, whatever. Or if not that, then we need a professional or trade organization that is offering this kind of coursework on an ongoing basis, year in and year out, and that provides some kind of certification standards. Third option is maybe if you're working for an appraisal group, you could maybe have some in-house coursework. We'll see whether that is up to the kind of standards that we want. Oddly enough, on top of all of that, if you somehow find you can get appropriate coursework as to the type of property that you're setting out to appraise, you still can't sign off on an appraisal unless you've been doing these appraisals for at least 2 years. So that kind of speaks again to this idea of an apprenticeship program. You're going to be making the appraisals, but you're not going to be the person signing off on them for at least 2 years. So that's, a large part of what is in Regulation A-17. It's page forward. I always forget what's on the next slide. Oh, so we come up to basically Ryan. I'm going to turn off my camera. Ryan is going to entertain you for a bit.
Yeah, thanks, Russ. So with that context for the appraisal regulations in mind, what is the donor actually trying to achieve with the appraisal when they have to get one? The short answer is they're trying to maximize that appraised value. They want to see that number as high as possible. Usually they want that to match the sale price on the asset. Because presumably when they've donated this asset, non-cash asset again, to the charity is probably not going to have a use for it. And we'll talk about related use. The charity is probably going to sell it right away. The donors knew or had at least a good idea of what it was worth. That's probably why they donated it. So they want that appraised value to look like that actual sale price. And an important point there is that donors, as taxpayers, are hoping to minimize any discounting that might be applied on the appraisal. We see discounts for lack of marketability and control very frequently with the gifts that we are accepting, oftentimes with business interests, because it is typically a small position. There is, little market because it's an illiquid private position, and there's little control because it's a small percentage interest. So appraisers reasonably are thinking about discounting. Donors do not want to see that discounting because it reduces the appraised value, which reduces their tax benefit. So some strategies that we've gleaned over the years in conversations with donors and their advisors to reduce the discounting, oftentimes use of a put option, which allows the receiving charity to sell the donated asset back to the donor at the charity's option. That, in theory, creates a market for the asset, which would mitigate the discount for lack of marketability, because the appraiser should know, because of that put option, there was at least one buyer for the asset.
Sometimes that will work. Sometimes we'll see a cooperation or a unanimous consent agreement when it comes to all the parties selling the asset. That can reduce discounts for control. You can see that with fractional donations of real estate as well. If it's a tenants in common interest, we have seen that utilized before. And sometimes the appraiser will agree to use the income approach for valuation, and that can be quite helpful as well. The bottom line is that if a strategy like this is going to be utilized, the appraiser has to agree with the strategy and be on board. So we always encourage donors to start these discussions with their appraisers sooner rather than later. So there aren't any nasty surprises when it comes to that appraised value at tax time. So before I dive into the 8283, I wanted to quickly send out a poll for everyone watching this. And if I do this properly, you should see. So the question is, if a donor is claiming more than $5,000 for multiple smaller gifts of similar items, do they need separate appraisals for each lot? The options there, yes, no, it depends, the law school classic answer, and then don't know, which was usually my preferred answer in law school. Looks like a pretty even breakdown here, about 25% each so far. Lots of quick responses here.
I was going to say, I thought half of you guys would be eating either lunch on the East Coast or breakfast on the West Coast, but you guys are very geekily attentive to this. So it's like 100 people responded in 45 seconds.
Yeah, and I think that looks like we'll just call it good there at about 75%. Yeah, that's about as good as you'll ever get. So, and that poll, and a pretty even breakdown. Like I said, slight edge to no need for separate appraisals. Russ, did you want to have some quick comments on that question?
Yeah, do we still have the question itself up? Because I remember that we framed it in sort of a tricky way. You begin from the point that if you are that they do want you to get an appraisal if you're contributing similar items. Do I put on my camera for this fun?
You don't need to.
Similar items that add up to more than $5,000. So we already know as a threshold matter, because we're contributing more than $5,000, we will need an appraisal. The trick aspect of the question is that any particular donee is probably getting less than $5,000. But there may be differences among the lots. You know, all of my bound first editions might be going to the university library, and all of my pulp mystery novels might be going to some literacy program or whatever. So the various lots might actually have different appraisals alongside them. So you need an appraisal because they're similar properties that add up to more than 5, but you probably, or you may still need separate appraisals for each of the separate lots. So back to business, Ryan.
Thanks, Russ.
Well, and I'll just jump in half a second, Ryan. I'm getting this question. I think cryptocurrency has been on everybody's radar, if you wanted it to be or not, frankly, in the last 2 weeks. And so I do a lot of these crypto appraisals, and I get this question all the time where it's like, well, wait a minute. Well, can I give Bitcoin? And then that's not similar in their minds than Ethereum, as an example. So the question really becomes is, now we're into the parsing out what does the word similar mean, just like we're talking about what does type mean. And so none of these have a crystal clear answer. I always say what should have actually been one of the polling questions is don't answer at all. Tell them to seek their own counsel. That's the one I always do. But go talk to your CPA. Don't sort of ask me. But you can see very quickly how something that should not be overly complex all of a sudden does, with some nuance, become much more so.
And the nuance, especially when it comes to those sorts of definitions, is kind of what we're going to dive into here when we're looking at the actual Form 8283 itself. So part 1 Section A, Part 1 at the top there, that is donated property 5,000 or less. In our experience, and probably most people watching this, you don't see that in use a lot when you are seeing this Form 8283. Normally, we're looking at Section B, donated property over $5,000. So the bottom half of the first page there is where the action really begins. Part 1 is a description of the donated property, and I've got a number of arrows to the different types, which Russ and Brian have already kind of talked about how that's a little bit unclear. You'll note that art is actually in the first arrow there. It's in two spots. Art for a deduction of $20,000 or more is one box, and then art 20,000 or less is another. Why is that broken out separately? Because the IRS requires that the appraisal be attached to the return if it is $20,000 worth of artwork being claimed or more. For other asset types, it is typically a $500,000 threshold before that appraisal needs to be attached. So that, I think, gives you some idea that the IRS is paying particular attention to charitable contributions of artwork. Vehicles seems quite straightforward. However, it includes a lot more than just cars for kids type donations. Boats, airplanes. I think someone on Tuesday commented that trailers were also included in that category, which I had not heard before. Vehicles is a much broader category than you might think. And then the good catch-all other, certainly that would include things like gifts of life insurance policies. Cryptocurrency, I think, should go in there.
That's where I jam it, so let's hope that's the correct answer.
And you do more of those than I do now. We spoke last month about NFTs, and I don't think any of us know which box NFTs would go under, whether it would be in one of the art boxes or collectibles or other. Really not sure at all for a newer asset type like that. And then below that is where all of the details on the property are included. Description of the property, amount claimed, basis, how it was acquired, when it was acquired, details of a bargain sale. All of those are included in line 3 there, which is actually a series of boxes and sections. On the second page of the 8283, highlighted in the red box at the top there, part 2, that was actually moved on to the second page, down from the first page in the most recent revision, which was just about 6 months ago in December. This was interesting to me because it seemed that the IRS was opening itself up for potential fraud because taxpayer could fill out the Form 8283, both pages, send off page 2 to the appraiser and to the charitable donee for signature, and then substitute in a new page 1 with an inflated deduction value. So I don't, perhaps I'm missing something, but it seems like the IRS could be dealing with some more taxpayer fraud using that rather simple tactic. The charities and the appraiser would never necessarily know. Previously, all of the details were on the same page that they were signing, so it was easy for them to verify what the taxpayer was actually claiming. Not the case anymore with this most recent revision in December, which has included the partial interest section on this second page. Part 4 there, you'll see the declaration of the appraiser. This is how all of those attestations that Russ was just talking about, this is how they look on the printed page. That font size seems to get smaller with every single revision. It does include all of their attestations as far as independence and fees and experience. So just something that is interesting, and I'll have some further comments in a moment about what the appraiser needs to include or be sure to include there. At the bottom, the donee acknowledgement, this is where the charity completes and signs. In the yellow box, that is the date section, and this is a practical point, but from Brian's experience, and I don't know if he wants to comment more on this, but it turns out that a lot of the e-filing softwares will not allow multiple dates in that field, which is troublesome for people who are donating things like cryptocurrency in different lots staggered throughout the year. Because that means they need to get a new 8283 for every single date that they donated, which could be quite a few. In green, this is something that we will hit a number of times. Does the organization intend to use the property for an unrelated use, yes or no? The IRS is paying clearly particular attention to tangible personal property donations and the related use rules. This pops up several times on the 8283 and the 8282, which suggests that that's something that's really gotten their attention, much like the artwork, and probably both of those together in tandem, frankly. Finally, below that in blue, the authorized signature. This is something, again, a practical point for charities. Who is authorized to sign? And related to that, I don't have a box around this, but the employer identification number of the donee charity should be certain to make to check that the EIN is going to match the entity that held legal title to the donated asset. It's easy to mix those up or to make an assumption that the asset was donated to one entity when perhaps it was another related entity that held title. If they have different EINs, it has to be the matching EIN for the entity that held title. So some questions that we commonly get on the form 8283 from donors and also sometimes from CPAs. The most common one from donors is, why do I have to do this? Is this really necessary? There was an arm's length sale. Can't the IRS just look at that? And the answer is simple. It is necessary. It doesn't matter that there was an arm's length sale. You still have to do it. Russ just went over this. It's very clear in the regs. There's not much wiggle room there, if any. Who completes this in what order? We feel as a best practice, it's better to have the donee charity sign last after all of the fields have been completed and the appraiser has signed. That is not technically required, although the donor is required to return the completed form to the charity after it is ready for filing. So easier just to get it and be the last one to sign and have it completed on file before sending it back to the donor. Can the donor sign the appraiser section? I think Russ has some comments about that in one of his cases that he's going to look at. Does the appraiser include their license number? Very common error for the appraiser to include their state appraiser license number instead of their taxpayer ID number. That happens very often, particularly with real estate donations. You see that quite a bit. Do we value the pass-through entity or the underlying assets? Think of a case where you have an LLC with a single asset like real estate. What gets valued there? Do you just get a valuation on the real estate or the LLC that was technically donated? It should be the asset that was technically donated, even if it's just a pass-through that has no operations or other assets. It doesn't matter. It's what was donated that needs the valuation, even if that is just a simple pass-through entity. Hard copy or electronic signature. We went back and forth on this. It does appear that the IRS probably does require a hard copy. However, I would say 8 out of 10 CPAs that we deal with and that I've seen over the past 5 or 6 years are comfortable with an electronic signature for whatever reason. So technically probably hard copy required. Practically seems that most CPAs are doing electronic signatures. Does it matter what the charity indicates for related use? I'm not sure I have a good answer for that question. We had a probably 5-10 minute discussion about it in preparation for this webinar, the three of us, and I'm not sure we came to a good conclusion on whether it mattered. Why is the charity asking for a copy? The charity's entitled to a copy, I guess, is the simple answer. And do we need a separate written acknowledgement, the contemporaneous written acknowledgement? Yes, the IRS is actually clear on that in the instructions for the Form 8283. These are separate documents. The charity still needs to provide that written acknowledgement, even if it is signing the Form 8283. It's not a one or the other type situation. The donor will need both. So I'm going to try another poll here. Let's see if I can get this launched. This is a question we also get all the time. Is it okay for a charity to pay for their donor's appraisal? This comes up a lot. And it looks like it's leaning pretty strongly towards no with the initial responses.
It says here the host and the panelists cannot vote. So
I have broken into the system, so I'm manipulating the vote.
Oh, okay.
That's a bad joke. That's a bad joke. Now we can't use this for the webinar video now.
Oh, yeah. Can't use it in Arizona.
All right, looks like we've got 76% there. Okay, so about 2/3 of the respondents said no, it's not okay for a charity to pay for their donor's appraisal. Again, we're being a bit clever with our phrasing there, a bit of a trick question. Technically, the charity can pay for the appraisal. However, I don't think any of us would be comfortable with the charities we're involved with doing that. There seem to be numerous downsides. Holding aside technical questions like, is the charity providing something of value to the donor? To me, it seems unwise for the charity to involve itself in the relationship that the donor has with the appraiser. That really should be a direct client relationship there. If the charity's involved and the appraisal doesn't turn out well, can the donor be, will the donor be displeased with the charity? I would say that's probably pretty likely. It really is better, I think, for the charity to keep itself at arm's length to the appraisal. Brian and Russ, I don't know if you had any other comments on that, but that's just kind of my thoughts on.
Yeah, Brian might. I know I do. It is a private benefit, obviously, to the and I think at the least it would be a quid pro quo, that you would have to acknowledge on your contemporaneous written acknowledgement. On the donor's side, in sympathy with the poor old donor, this is not something for which the donor can claim an additional charitable contributions deduction. It would be a personal expense that would be deductible as miscellaneous itemized on their Schedule A, except that for the nonce, we don't have miscellaneous itemized through 2025. So it's just something that the donor has to eat. So, Brian, you might have something as well.
Yeah, the only thing I would say, that's correct. It's always nice when the three of us are speaking and we all agree. That does not actually happen all the time, which we've discussed as well too, which is okay. But I think what you said, the main thing is that it's clear within sort of publication 561 and 526 that it's really the donor's responsibility as the taxpayer to substantiate his or her deduction. And if you start from that premise, that really means that the donor is the one obviously then selecting, engaging, paying for the appraisal. I do have probably 5 to 7 charities, in particular on the life insurance side, and 1 or 2 on the crypto side, that say, no, this will be a convenience that we'll have, we'll pay for the appraisals, and then we'll sort of deal with it on our side relative to the substantiation letter. As Ryan mentioned, would really be consideration received. And then so technically to sort of play that through, how that manifests itself is whatever the deduction is, then that deduction would of course be reduced by the amount paid as consideration on behalf of the donor by the charity. I'll go the other way though. Ryan sort of talked about the potential donor relations issue if the appraisal doesn't sort of come out as the donor sort of expected. The other side, actually very interesting, at least to us, is on our work with the Decamine Foundation and Noncash, in fact, the donor is most concerned that we actually would be involved with the appraisal. And so a lot of the questions are something like, well, who's picking the appraisal? How do I have control sort of over that selection? And I think the premise is, as the crazy charity, you're going to go out and hire somebody in Kansas or my real estate in San Diego, and they would say, no, it's your responsibility to select your appraiser and to go through that process. And you can almost hear palpably on the phone, like, oh, okay, that makes me actually much more comfortable in that I have people that I've worked with before that otherwise can be particularly good appraisals for that asset. So that's where the other side of the coin is. In many cases, donors want to be very involved with that, but to the extent that they don't, then I very much believe it'd be a consideration received as it relates to the substantiation letter. I think I've had one or two charities even choose to do 1099s to the donor for that amount. I think that's over the top, but again, their tax advisors can sort of figure that piece out.
Yeah, thanks, Brian. So I'll just whip through the 82 quickly and then send it back to Russ to wrap us up here with some case law. The 8282, the tattletale form, this is where the charity reports the sale of a donated non-cash asset. If it is selling 3 years after receipt, it used to be 2 years, now it is 3. Charity has to include identifying information for basically everyone involved except for the buyer of the asset. The charity's information on the original donor and the successor donee, if there was one. The original donor, one thing to keep in mind there, it does require the tax ID of the donor. In Part 1(1)(b) there, the identifying number. So you as the charity will need to get that information at some point if there is a sale. Maybe a good idea to get that up front so you're not chasing after the donor later. Part 2 there, information on previous donees. This really is only going to come up if the asset was received as an in-kind grant. That is pretty rare for us, at least. Maybe twice a year we have that happen, so that section does not get filled out all that often. Second page, like the 8283, just a 2-page schedule. You can see a section at the top to the left of where the red box is, a description of the donated property sold. Again, the IRS wants to know what you as the charity sold. They are asking, interestingly, whether this was the entire interest in the property. So if it is a partial sale, you are disclosing that there. And then more questions and spaces for responses to the right of that, having to do again with tangible personal property and related use. I said that that would come up again, and this is where we're seeing it again on the 8282. The IRS is clearly paying attention to related use and disposition of tangible personal property by charities. So certainly something to keep in mind with those types of donations. And then below that, I have a green box there, the date the property was sold, exchanged, or otherwise disposed of. That's important for 2 reasons. First, because of that 3-year time period, if it's been more than 3 years, this form doesn't need to be filed. However, it also starts the clock of when it needs to be filed by. This form has to be filed within 125 days after the property was sold. So it's about 4 months. A bit of an unusual time period that the IRS selected there, but that is the time frame that you as the charity have to file this after a sale. In the yellow box below, the amount received upon disposition. Worth noting here, that is the gross sale price, not the net. So if there were significant closing costs, that doesn't matter. The amount received should be the contract price. And then below in Part 4, certification, this is where the charity always signs at the bottom of the page, but there's an additional certification, again, having to do with tangible personal property. As I've said, clearly a lot of attention being paid to that type of asset. And so just questions on the form 8282, the questions we ask ourselves, most of these I've just been through. The one that I did want to mention was, do we need to file if this was an asset sale? For a long time, I went back and forth on that until someone finally set me straight and said, if it was an asset sale and you still technically hold some sort of stub shell entity interest, then the 8282 actually does not need to be filed. So that is it for the Form 8282 and Form 8283 as far as an in-depth look on those, and I'll pass it back to Russ for a quick run through the case law.
Yeah. Okay. So, as we've sort of suggested, there's a lot of T's to cross, a lot of I's to dot on these forms. And then the question is, okay, I did my best. Was it good enough? Because if I somehow fail to at least substantially comply with the requirements, the reporting requirements, then the penalty is that I get my deduction denied altogether. Okay. So early on, the tax court said, look, some of these requirements obviously are just information IRS thinks would be helpful to help them identify, sort of do the triage, figure out which returns they want to pay attention to or not. And some of them might actually be mandatory. And if you fail to answer the question, provide the information that's being requested here, then that does kill the deal. They made the tax court made this distinction back in 1993 in a case called Bond. Oddly enough, from reading that opinion, you wouldn't have any clue that anything was mandatory. They kind of treated everything as directory. But we have had some stuff along the way in the meantime, and obviously the two items that Congress called out when they first legislated in this space back in '84, date of acquisition, cost basis, those things have been identified as mandatory. And these, Brian introduced the entire hour by talking about footfalls. So you take a look at the Hewitt case, another reviewed decision in 1997. Nobody was saying that the taxpayer had overvalued the property. There was no dispute as to the value, but it was over $500,000, and they didn't actually do a formal appraisal, and it was over $5,000, and they didn't attach a report to the 8283. They simply didn't even meet the basic threshold requirements there. They were denied their deduction, even though there was no real dispute as to the value of the assets being claimed. So let's page forward, look at the next one. I'm kind of laying the groundwork here. So as of the decision in our ERI holdings, it is absolutely clear that date of acquisition and cost basis are mandatory. You omit those, and you don't have a good excuse for omitting those, then you just don't get a deduction at all. In that case, it was like a $6 million deduction. You read the case, you'll see that it was sort of an imaginary asset, and it obviously was being valued on artificial criteria. That's neither here nor there, because this is where the bad law is being made. IRS has a war on against this kind of thing, fictional assets, and especially Oak Hill Woods is a conservation easement, syndicated easement case. And if they don't want to have to spend years putting together the expert testimony on how to value these crazy assets, they're looking for an easy way to say, look, you just don't even get a deduction at all. And so in Oak Hill Woods, this was, again, a matter of omitting the cost basis and the date of acquisition, because as is typical in the syndicated easement cases, they bought the property last year for a fraction of what they are now claiming is the value. But they attached a statement saying, well, here's the reason why we're not disclosing cost basis and date of acquisition is because it has nothing at all to do with the value that we're now claiming, which of course, obviously is wrong. But the other argument they were making was, well, it's a big return. You look elsewhere in the return, it's a partnership return. You've got the balance sheet, you've got the asset, the profit and loss statements. Take a look there. You will readily see when we bought the property and how much. And the tax court basically said, the purpose of the 8283 is to make it unnecessary for IRS to go searching around in your return looking for the answers to these questions. You're supposed to flag this information on the 8283. Not sufficient, deduction entirely denied. Let's take a look at the next slide. So here's some other things that people sometimes trip over on these things. In the case of Mohammed, The guy was making contributions of real estate. He was a real estate professional. He knew perfectly well what these properties were worth, and he put the valuations on the return himself. And he signed literally the 8283 saying, well, I'm the appraiser. Well, obviously, as we mentioned, maybe just in passing earlier, there are relationships that the appraiser cannot have with the donor, the donee, the party that sold the property to the donor. If the appraiser is related to those folks, they are not qualified to be the appraiser. So even though, again, there was no question that the property really was worth what Mr. Mohammed said it was worth, he still got his deduction denied. More commonly, you will see things that happen like in Evenchik and in Krem, where you do have an appraisal. You had a lot of stuff going on, and you needed an appraisal anyway. But what the appraiser ends up appraising is not literally the asset that's being contributed. In the case of Evenchik, the appraiser appraised the buildings, but the buildings were held in a corporation, and what was being contributed was the stock. And we didn't have an appraisal of the stock, which of course would have included questions like, minority discounts and transferability. In Krem, they had an appraisal that was really contemporaneous with the entire transaction, because at the same time that they were contributing some of this stock to a community foundation, donor advised fund, they were also primarily using this transaction to fund an employee stock ownership plan. That's where the appraisal was made. Is the price fair to the ESOP? And that's the appraisal they attached. And here the tax court stepped in and said, well, that's an interesting argument that you're making, taxpayer, on this cross motions for summary judgment. So we're going to deny the IRS's motion for summary judgment. But be aware that when this question comes to trial, you might win, you might lose. And what happened there was that this issue was basically used by the court as leverage to force the parties to the settlement table. So I think that we wanted to drop in one more polling question, and then we'll hit the last slide. Is that how this works?
Yeah.
Why don't we just go ahead? Why don't we go ahead, because I think we're about right on time now. So,
okay.
Yeah.
All right. We wanted to hit one more question. This again relates to the relationship between the appraiser and any of the parties to the transaction. Meyer, of course, is an egregious case. The guy, he was an operator, and he was all over the transaction. He created these fake little DAFs. He did the appraisals. He backdated documents, and he entered into a consent decree with the Department of Justice saying, okay, I understand that I'm never going to do another appraisal or prepare a tax return in my life. Okay, but you will see on this statement that the appraiser is signing on page 2 of the 8283 saying, if I am an appraiser who is regularly being used by the donor, by the donee organization, by the entity that sold the property to the donor, I hereby certify that if I'm being regularly used by these people to do appraisers, I also have an appraisal business, and I do most of my work for other people. That is a threshold that may not always be that easy to meet if you have sort of a captive appraiser. So a thing to watch out for. Okay, I guess I'm out.
Well, that's really it. So I think we're about 1 minute over. I want to be very respectful of everybody's time. So I think we're able this time to do most of the Q&A as we went through. So probably what's best is just want to thank everybody for attending, number one, but both Russ and Ryan for, I think, a great presentation. We've got a couple articles that have been appearing on this topic on Forbes, sort of taking some of the things that we've discussed today. But I do hope for the fellow geeks on the phone that this was helpful. Believe it or not, I think there was still actually maybe another 15 or 20 minutes of material content we could have covered. When we first started this, we thought, maybe 30 minutes or so, and the deeper we got into it, they're like, man, there's a lot of stuff here to deconstruct and unpack. So again, hope it's helpful. Hope you like our webinar series, and we'll be sending out the link and the Q&A for both last session and this session next week. And you guys have a great rest of your week. Thanks so much, Russ and Ryan.
Thank you.
Great. Thank you.